Hello and welcome to Investment Insight, your clear take on the markets. Let's get started. We have two major, really interconnected financial shifts we're exploring today, and they affect pretty much every asset class, from a standard stock all the way to Bitcoin.
That's right.
So first, we'll look at how the bedrock infrastructure of U.S. securities is going digital, which, fundamentally changes when and how we all trade.
And then the second piece is this new, really essential way institutional investors are starting to value Bitcoin.
Not just in dollars.
No, not just in dollars, but in its strategic relationship to gold.
Okay, so what's our mission here?
Our mission for this deep dive is to really synthesize the key findings from some recent analysis on both of these topics. We want to give you, the individual investor, some clear context and what the implications are, without getting totally lost in the technical jargon.
Because these shifts are happening fast.
Very fast. And understanding the plumbing is just as important as understanding the price.
Okay, let's start with that plumbing. Institutional asset tokenization. When most people hear tokenization, I think they imagine, speculative cryptocurrencies.
Right, random virtual coins.
Exactly. But the sources we've looked at define this very differently. This is about the digital representation of real assets.
Real assets. We're talking things backed by actual value, like the dollar or corporate balance sheets. And this is the big one, U.S. Treasuries. It's an infrastructure upgrade, plain and simple.
And what's fascinating here is how the establishment is sort of giving this its stamp of approval.
It is. The strongest evidence that tokenization is really entering the mainstream centers around the DTCC, the Depository Trust and Clearing Corporation.
Okay, can you just quickly remind everyone what the DTCC is and why their involvement is? I mean, why it's such a big deal?
Of course. Think of the DTCC as this quiet, massive backbone of the entire U.S. financial system.
The plumbing.
The plumbing. When you buy a share of stock, the DTCC is the one responsible for the actual settlement. They make sure the cash moves and the security legally changes hands. They handle trillions of dollars a day.
Trillions.
Trillions. And now they've received what's called a no-action letter from the SEC for tokenization services.
A no-action letter. That sounds like a technical term. For our listeners who are newer to this, what does that actually mean in practice?
It's essentially the SEC saying, look, based on the specific detailed plan you showed us, we won't bring an enforcement action against you for this activity.
So it's regulatory clarity.
It's regulatory clarity. It means the core U.S. securities infrastructure is building a legitimate, compliant bridge to existing securities using digital tokens. This isn't permission for every crypto project out there.
No, this is for the system itself.
Exactly. It's permission for the foundational settlement system to go digital.
That shift feels tectonic. It means this isn't some fintech upstart running a pilot project. This is the establishment changing its whole operating system.
It is. And the analysis says the DTCC is planning a pilot in the first half of 2026.
With a full rollout when?
Expected in the second half of 26. And the scope is huge. They're planning to tokenize U.S. Treasuries, which would expand the efficiency of settlement, collateral, and the whole repo market.
The repo market. Can you break that down for us?
Sure. Repo is short for repurchase agreement. It's where big institutions lend and borrow super liquid collateral, usually treasuries overnight.
It's like a pawn shop for financial giants.
That's a great way to put it. Now, if you can use a tokenized treasury instead of a traditional one, settlement becomes instantaneous. You go from waiting a day or two down to basically zero. It speeds up the entire system.
But, and this is a crucial distinction, does the DTCC getting this green light mean that all tokens tracking assets are now safe?
Absolutely not. And we have to be really clear here. You have to separate what the DTCC is doing, which is connected to the traditional custody and rights structure, from these, third-party tokens that just track a price.
What's the risk there?
Well, SEC Commissioner Hester Pierce has warned about this. She said that while tokenized securities are still securities and fall under existing rules, these third-party tokens can carry different risks because the underlying investor rights might not be identical.
So you have to know who's guaranteeing the asset. Is it the DTCC or some newer, less regulated company?
Precisely. It's a critical difference.
Okay, that makes perfect sense. Now let's move to the innovation investors we'll probably see first, the trading hours.
Right.
Traditional markets are, 9.3 and 4.00 basically. But tokenized assets are technically capable of running almost nonstop. We're talking 246 trading.
And this raises the question, is this just hype? or is it really happening?
And it's happening now.
It's already happening. Recent analysis confirms it. Robinhood, for instance, launched 245 token trading for over 200 U.S. stocks and ETFs for their European users.
And it's not just the new guys. NASDAQ filed amendments with the SEC to allow for tokenized trading.
That's right. The big official exchanges are getting ready to compete. And you have the new Texas exchange, the TXSE, slated for a 2026 launch. That's only going to accelerate the competition over trading hours.
So the convenience of selling anytime is obviously appealing. But what's the trade-off?
The trade-off is potential exposure to price distortion. Imagine you're trying to trade a tokenized stock at 3 in the morning on a Saturday, right after some major geopolitical news breaks.
That sounds like a recipe for some serious volatility.
It is. When you have low liquidity, meaning very few buyers and sellers, any sudden news or a single large trade can cause these huge price swings that just wouldn't happen during regular hours. The market gets thinner, less reliable.
Okay, so what does this all mean for the daily investor? The biggest fallout seems to be confusion over what's called price discovery.
Yes.
You could have the real stock price on NASDAQ and then a tokenized version price trading somewhere else, and you might see two different numbers. Which one is correct?
This price gap is likely temporary, but it's critical to understand the three things driving it. First is what we just talked about, rights consistency.
Right.
If the DTCC system ensures the digital token has the identical rights, protection, and ownership as the traditional stock, then a mechanism called arbitrage should quickly close that gap.
Can you give us a simple analogy for arbitrage?
Sure. Imagine a hamburger selling for $5 at a stand in New York, but the exact same hamburger is $4 in New Jersey.
I'm buying in Jersey.
Of course. And smart traders would immediately buy all the cheap ones in Jersey and sell them in New York until the prices equalize. If the token and the stock have identical rights, traders will do the same thing, buy the cheap one, sell the expensive one, until the dual pricing disappears.
But if the rights aren't identical, that arbitrage doesn't work perfectly.
Exactly. The gap could stick around. The second factor is liquidity. When the regular market closes, the token market is the only game in town for price. So if big news breaks overnight, the tokenized price can jump or fall dramatically.
Which creates a huge, maybe even violent gap when the main market reopens hours later.
Yep. And the third factor is regulatory harmony. The traditional exchanges are already warning that if you give special regulatory carve-outs to certain players, it could disrupt market fairness.
So everyone needs to be playing by the same rules.
For stable price discovery, yes.
Okay.
Everyone needs to operate under the same oversight. If one company can offer 246 trading with looser rules than NASDAQ, it just distorts the whole picture.
So this temporary confusion over price will only really resolve if you have those three pillars: identical rights, strong arbitrage, and consistent regulation.
You got it. This is turning market structure into a critical variable we all need to watch.
Okay, we've looked at how the structure of securities is going digital. Let's transition now from securities to scarce assets, gold and Bitcoin, and see how institutional managers are analyzing their relationship.
Perfect segue. We're moving beyond just looking at Bitcoin's price in dollars. The analysis from Ned Davis Research, or NDR, shows that for institutional investors, the Bitcoin to gold ratio has become a surprisingly useful long-term signal.
Okay, let's unpack that. The ratio is just Bitcoin's price divided by gold's price. But why does that suddenly matter more than, say, Bitcoin versus the S&P 500?
It matters because institutions are now managing gold and Bitcoin in the same bucket. They see them as competitors for the same role in a portfolio, a store of value or a scarce asset.
And NDR is a pretty respected source.
Very respected. They identified a specific structural support line that this ratio recently approached in early 2026.
And what were the market conditions when the ratio hit that floor?
The sources show it happened when two things were going on. First, gold was relatively strong, because of geopolitical uncertainty or central bank buying.
The usual reasons.
The usual reasons. And second, Bitcoin was in a cooling off period. The analysis said excessive expectation had cooled. It wasn't that Bitcoin had crashed, but its momentum had just slowed way down compared to gold's steady climb.
So NDR's conclusion isn't that Bitcoin is cheap in dollar terms, but that the relative valuation between the two, digital scarcity versus physical scarcity, had just gotten way out of whack.
Exactly. It's a signal of a major but likely temporary imbalance in sentiment.
So why did the ratio fall recently? The data shows gold stayed strong because of global geopolitical risk and that structural central bank buying.
Right, especially from emerging economies. Gold was holding its own as the go-to safety asset.
And on the other hand, Bitcoin saw some adjustments. Why was it lagging?
Well, Bitcoin saw some profit-taking, and it just had lower appeal compared to the booming stock market and the AI rally we've seen. Investors chasing growth were putting their money in tech, not Bitcoin.
So that intensified this really simple narrative. Gold is safety, Bitcoin is risk.
Right, and that narrative pushed the ratio down toward its historic cycle lows. NDR interprets that as historically excessive conservatism. The market got too fearful and just favored gold way too heavily.
That's a really important insight. The analysis stresses that the signal doesn't mean gold has to get weaker.
Not at all. It just observes that when Bitcoin becomes too cheap relative to gold, capital will eventually try to rebalance that equilibrium. It's like a substitution trade just waiting to happen.
What's fascinating here is that institutional entry means Bitcoin is no longer this independent novelty asset.
It's being compared and selected right within the same bucket as gold. Managers aren't asking, do I buy tech or Bitcoin?
They're asking, do I allocate to physical scarcity or digital scarcity?
Precisely. And this connects to the bigger picture. The key investment question is no longer just will Bitcoin rise in dollars. It's now, what is Bitcoin's position relative to gold?
Yeah.
We're running relative value trades between the two.
So how do you apply this strategically?
The sources are pretty clear that the ratio is a rebalancing signal, not some magic directional trading tool. It tells you when your portfolio is out of balance.
So for a portfolio that became overweight in gold during uncertain times, this low ratio is a signal.
It's a strategic opportunity to maybe incorporate some Bitcoin to regain that relative value balance. It's about long-term stability, not short-term price prediction.
I see. It's using the ratio as a sophisticated tool for managing risk.
Correct. And there's a neat historical signal attached to this too. The data shows that when Bitcoin rebounds from this ratio floor, it often signals that the market thinks the worst macro scenario, like extreme dollar strength or credit spreads widening, is starting to ease up.
Interesting. So it's a subtle sign that systemic risk might be moderating.
And that risk capital can start flowing back into digital assets.
That was a tremendous deep dive. Let's do a really quick recap for you. First, institutional tokenization is making 246 trading a reality thanks to DTCC regulatory approval.
But be warned, this complicates price discovery. You have the risk of dual pricing and those low liquidity gaps, which are only solved by regulatory consistency.
At the same time, institutional investors are now using the Bitcoin to gold ratio to manage risk across scarce assets, treating them as competitors.
And when that ratio hits historic lows, it often signals an opportunity to rebalance capital away from what might be excessive conservatism.
So, a final provocative thought. The most critical factor for you to track in 2026 isn't the speed of the technology.
No, it's the regulatory convergence, the speed at which the SEC, the DTCC, and the traditional exchanges all apply consistent rules to these tokenized assets. The success of this whole thing hinges less on the code and more on who wins the competitive fight for market share and consistent regulatory oversight.
If the rules are clear and equal, the innovation will truly thrive.
Fantastic insight to leave us with.
Don't forget to subscribe and hit that like button.